70 record closing highs so far for the Dow.
Blasting through a ceiling.
In a record-setting IPO.
Investors who have been riding the wave.
The stock market goes, so goes the wealth and the health of the American economy.
What the market is telling us is that we are on the road to prosperity.
In the skyrocketing stock market, and that benefits everyone.
Let's get the opening bell here.
So in this video, we're learning all about what is the stock market. So you've seen this phrase, heard it all about. We're going to go in depth here. What is the stock market? What is a stock? How does it all work? And how do you start getting into it yourself? So before we get into what is the stock market, first we need to narrow down the question, what is a stock? So a stock is just ownership in a company that you can buy or sell. And it's traditionally in the form of shares. So in owning these shares, you own some portion of the company. So let's do an example here where we got you and the person or organization you're buying this from. So it can either be that a company is selling shares, a money manager is selling shares, or just another person selling shares. So you want to buy these shares of some company. So you put forth some money down and you buy 100 shares, which is 2% ownership of this company. And so you buy the shares, and now you have that 2% ownership, and the person that you bought them from gets the money. And what your goal is, you actually want to sell these for a higher amount in the future. So let's fast forward 10 years later, and now you're ready to sell your 100 shares to another person or organization, whoever wants to buy them. And so they buy them for more money than you sold them, and now you get the money back, and now they own the shares. And so if you check out your original investment here, it was this amount, and so you tripled it in 10 years. So again, you got the original investment that you bought the shares for, and then after 10 years, you tripled it once you sold it to another person or organization. And that's literally all you are doing with stocks. You want to buy low and sell them for a higher price. So there's two types of stocks. There's public stocks and private stocks. So public stock is shares that can be bought or sold on public exchanges. So anyone can buy them. Whereas the private stock is shares that can be bought or sold on private exchanges. So it's much harder for average people to get into and much harder for the average person to buy. So in this video, what we're going to do is we're going to focus on the public stock and how to buy and sell public stocks. And so what we're specifically going to focus on is the U.S. stock market. And there's many global stock markets. Many countries have their own stock markets and exchanges, but the biggest in the world is the U.S. stock market. And so the U.S. stock market is the market that's consisting of all the publicly traded companies that are listed on U.S. exchanges. So there's not necessarily all U.S. companies. There's a lot of foreign companies that want to be listed on the U.S. exchanges. Most are U.S. companies, but again, there's a lot of foreign companies also listed on the public U.S. stock market. So an exchange is a place where you can buy and sell stock, and this can be in person, over the phone, or online. And again, today, online is the most popular format because it's very easy. You can just press a button and it sells within 1 second. Versus in the past, you'd have to have a broker call and sell them over the phone or in person. So it was much harder for the average person to make trades themselves. You had to usually go through a third party. Versus now, everybody can do it themselves using an online forum. So how do companies become publicly traded companies is another question you might have in your head. So the way you get listed on the U.S. stock market is that you have to go through this lengthy legal process called an initial public offering, or IPO. So that's what IPO stands for, is initial public offering. And it's a legal process that they go through. It takes a long time. And once that is completed, the company then is listed on U.S. exchanges and is open to be bought and sold by the public. So one final note about the U.S. market specifically. So the U.S. stock market is open for trading Monday through Friday from 9:30 a.m. to 4 p.m. Eastern Time. So if you live on the West Coast, that means the hours are 6:30 a.m. to 1 o'clock p.m. to make trades, and you can buy, sell any company listed on the US stock market. So one thing to note is that most major US companies are publicly traded companies. Not all of them, but most of the time if there's a big name company in the US, odds are that you can find it on the US stock market. So again, you think of companies like Nike, Apple, Amazon, Google, Facebook, Zillow, all these companies, and there's many more. There's over 19,000 companies listed on the public markets in the US. And so how do you buy and sell them? So what you do is you buy and sell them using their ticker symbol. And so each company has a specific ticker symbol unique to that company. It's usually very similar to the name of the company. So for example, Nike's ticker symbol is NKE. So when shares are bought and sold, it's bought and sold using that symbol NKE. So you don't trade Nike necessarily, you trade NKE. Amazon's is AMZN. Apple is AAPL. Facebook is changed their company to Meta, so their trading symbol or ticker symbol now is Meta. Google is just Goog, and Zillow is ZG for Zillow Group. So there's, like I said earlier, there's over 19,000 companies listed on the US market. So whenever you see something like the market's crashing, whatever, this, that, it's not always that the entire market's crashing. It's very difficult to track. So what most of the media does is they actually use indexes to track how the market's doing. And so whenever they say it's crashing or it's having a great day, it's usually based off just 3 index. So it's not based off all 19,000 companies. It's based off these indexes that they use. And the indexes are just ways to track certain companies. So there's 3 of the most common ones, and we're going to go over each one very briefly. So you got the Dow Jones, the NASDAQ Composite, and the S&P 500. Those are the 3 main indexes. And whenever you see on the media the market's having a great day or it's crashing, it's usually they're citing one of these 3. And so let's start off with the Dow Jones. So the Dow Jones is the most popular, I would say, by the media, but it's really only made up of 30 of the top US companies. So in my opinion, not a great indicator of an entire market. Because it really is only 30 companies, and the companies that are in it are selected by the Wall Street Journal and editors on the Wall Street Journal. So that's what the Dow Jones is. So whenever you think Dow Jones, if you say, oh, the stock market's crashing, but they cite the Dow Jones, just know it's only 30 companies in the Dow Jones. Second one is the NASDAQ Composite. And the NASDAQ Composite is made up of all the companies listed on the NASDAQ exchange. So there's about 2,000 in total. And one thing to note about the NASDAQ is the NASDAQ tends to be more tech-based companies. A lot more of the tech industry is the NASDAQ. So if they say the NASDAQ's having a good day, usually it means it's a good day for tech stocks. And then the last one is the S&P 500. This one tracks 500 of the largest companies listed on U.S. exchanges. Again, not all of them are U.S. companies. It tracks the 500 largest companies listed on U.S. exchanges. And I would say this is usually the most accurate indicator of the economy and the stock market. So if they say the market's crashing and the S&P is crashing, usually that's a better indicator than I would say the Dow Jones. However, all 3, NASDAQ, Dow, and S&P usually have, if they all have a good day, they'll all have a good day. If they all have a bad day, they all have a bad day. So I'm going to put a star again by S&P 500 because I think this is the best one for tracking the entire market. So I'm going to make this note about the S&P 500, and I'm going to put a second star here because not only is it the best for tracking the market, but it's also the best to invest in. So a piece of advice I have is when in doubt, invest in the S&P 500. And this is because since its inception in 1926, the S&P 500 has gained an average of 10% interest year over year since 1926. So talk about that estimated interest return. 10% is a very, very good number. And again, that is a historical average going back almost 100 years. So it's a pretty good piece of data, that 10% average year over year. Again, you're going to have some down years, going to have some very good years, but that average is what's important of 10%. And don't take the advice from me. Take it from, again, one of the best investors of all time, Warren Buffett. Here's his advice on that.
The same thing that makes most sense practically all of the time, and that is to consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin, because the temptation gets, when you see bad headlines in newspapers, maybe to say, well, maybe I should skip a year or something. Just keep buying it. American business is going to do fine over time.
So that is Warren Buffett's advice. Invest in the S&P 500 as often as you can. So let's move on from the major indexes to something called ETFs. That's not going to make too much sense, just the three letters ETF, but ETFs are what you can do if instead of picking individual stocks, you can invest in stock portfolios called exchange traded funds, or ETFs for short. And so by investing in ETFs, you take a lot of risk off the table. It allows you to invest with less risk, because it can be hard to pay attention and you try to buy and sell stocks on your own. But if you buy an ETF, you know professionals are doing this and they're monitoring it and they're deciding what companies to put in this ETF portfolio. So if you wanted to invest based off that estimated, you want to get an estimated 5% per year, best way to do it is just by buying ETFs. So there's many different types of ETF portfolios that focus on different sectors, and I listed some of the more popular ones down here. So you have the SPY, that ETF, and that's the ticker symbol that you would buy at, the SPY. That one just buys all the stocks that are in the S&P 500. So if you want to just buy the S&P 500, SPY is the way to do it. QQQ is another investment ETF, and that one invests in the top 100 companies in the NASDAQ. So like I said, there's about 2,000 companies on the NASDAQ, but QQQ takes the top 100 and invests it into those. Then you have the Russell 2000. That invests in like 2,000 smaller up-and-coming public companies. So if you want to maybe a little more risky, some up-and-comers, Russell 2000. And then ARK-K, that one is a portfolio run by Kathy Wood. She's an investor, and they focus more on like high-tech, exponential growth stocks. That one is higher risk, higher reward. But again, if you're going ETFs, there's a bunch of different directions you can go. Video answering the question how to invest. Because once you are 18, you can sign up for a personal brokerage account and start actually investing real money. And you can buy individual stocks, ETFs, or a combination. And again, the key is starting younger is better because you can build that compound interest. You also can learn from mistakes. So I'd recommend once you are 18, you should sign up for a personal brokerage, and you don't have to put a ton in there, but just kind of experiment around. And the more confident you get with it, the more you can start putting in. So some different brokerages online that you can buy and sell stocks and ETFs are, here are some of the main ones listed below. So you got E-Trade. That's a very nice and easy one. You have Robinhood. Maybe the most user-friendly interface is Robinhood. Acorns, if you don't like risk, I really recommend Acorns. You can just put in like X amount per week or per month. You can just set it automatically. And this one buys a combination of ETFs and bonds for you. It just buys it for you. So you really just have to funnel it in there, and then they do all the heavy lifting for you. So Acorns is definitely the safest route. You got TD Ameritrade is another online brokerage. Webull and Robinhood, you can do stocks and crypto. The other ones do just stocks. And then the last one is Merrill. So any of these companies, if you were interested in investing once you turn 18, you can sign up with an account and actually put money into any of these ones. You can buy or sell online starting when you're 18. And they're all pretty much the same. Acorns is a little different because it's more safe. The rest, you are actually buying and selling your own stocks or ETFs. So everybody's strategy is different. I'd say just do research, know what you're buying, and best of luck in your investing future. And like I end every video, have a nice day.